Welcome to the channel. Here we will take a look at the trending topics together. If you're ready, let's go. The topic of the day is the crisis in First Republic Bank. With the bankruptcy of Silicon Valley Bank and Signature Bank in the USA, dark clouds began to circulate. Let's take a look at the important highlights first. First Republic announced on Sunday that the Federal Reserve and JP Morgan Chase had provided it with additional liquidity. The bank claimed that the action increased its available liquidity to $70 billion before it received any money from a potential new Fed facility. A new bank term financing program was established by the Federal Reserve, which will provide banks with loans for a period of up to a year in exchange for Treasury securities as excellent collateral. After authorities' unusual move Sunday evening to guarantee all deposits in the collapsed Silicon Valley Bank and Signature Bank and to provide additional funding to other distressed institutions, First Republic Bank was at the forefront of a Monday fall in bank shares. After falling 33% the previous week, First Republic shares in San Francisco dropped 61.8% on Monday. As regional bank stocks sank substantially, PacWest Bank fell by 45% and Western Alliance Bancorp lost more than 47%. While KeyCorp plunged 27%, Zions Bank Corporation lost around 26% of its value. Other financial institutions were also under pressure. Charles Schwab fell more than 11%, while Bank of America fell 5.8%. Throughout the day, many bank stock prices were repeatedly paused due to volatility. The decreases occurred despite the Federal Reserve's announcement on Sunday that it had established a new bank term financing program, which will provide banks with loans for up to a year in exchange for treasuries or other high-quality collateral. Also, the central bank loosened restrictions on its discount window. First Republic announced on Sunday that the Federal Reserve and JP Morgan Chase had provided it with additional liquidity. In addition to any money it would receive from the new Fed facility, the bank said that the move increases its unused liquidity to $70 billion. Founder Jim Herbert and CEO Mike Roffler stated in a statement, First Republic's capital and liquidity levels are very solid, and its capital is well above the legal benchmark for properly capitalized institutions. On Monday, Herbert also told CNBC's Jim Cramer that the bank was conducting business as usual and that not many depositors were withdrawing their money. In a statement, Western Alliance claimed that it was experiencing modest outflows and that it had taken extra measures to increase its liquidity. The SPDR S&P Regional Banking ETF, however, fell 16% last week, before losing 12% on Monday. As SVB Financial was forced to close due to a spike in withdrawals, regional bank stocks fell on Monday. Since that the majority of the bank's customers were not assured of receiving their money back prior to the weekend regulatory actions, SVB's high percentage of uninsured deposits was a significant problem. Despite the exceptionally high proportion of uninsured deposits at SVB, there are other mid-sized banks that might be vulnerable to big withdrawals. We think regionals, which have less diversified and sizable uninsured deposit bases, are vulnerable to deposit flight, though not at the same rate as SVB, and they should have time to access wholesale funding markets and boost cash levels. According to Citi analyst Keith Horowitz in a note to clients, we believe banks should be cautious about the possible negative signaling effect of boosting deposit rates to maintain deposits in a fragile situation like we are in. With $212 billion in assets, SVB was the largest U.S. bank failure since 2008. As of December 31st, First Republic's assets were estimated to be worth $213 billion, per a securities filing. First Republic caters to enterprises and affluent people with sizable uninsured deposits, albeit it is not as specialized in one sector as SVB was with technology. Chris Katofsky, an analyst at Oppenheimer, wrote in a letter to clients, unfortunately, one of the first implications of SIB's failure is undoubtedly that it will drive a flight of uninsured deposits from smaller, less varied banks to larger, more diverse ones. That's all the news from us for now. Stay tuned.